Welcome to the TAC Index AI podcast, February 5, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics, with a focus on air cargo.
It is good to be here. And looking at the data this week, it really feels like the market has finally woken up from that holiday lull.
It really has. I mean, January was so quiet, which, was pretty typical, but now we're seeing this very sharp mini peak right before Chinese New Year.
Exactly.
So our mission today is to connect those dots. We want to figure out how these rates are defying the usual post-peak slump and what all these global disruptions from geopolitics to jet fuel really mean for the macro market.
Well, the defiance is right there in the numbers. We're looking at the TAC Index report from February 3rd, the Global Baltic Air Freight Index. That's the BAI0. It jumped 4.1% in just the 1 week leading up to February 2nd.
Wow. And that jump effectively erases most of the year-on-year gap, right?
It does. We're now only trailing last year by about 3.0%.
Yeah.
The real story, I think, is in the regional details. It's not a simple global lift.
No, not at all. Because if you look at Asia, the region isn't really behaving like a single block.
There's a real divergence. Take Hong Kong, the BA30 index. It's essentially flat, up just 0.1%, barely a rounding error.
Right. But then you look at Shanghai, the BAI80.
And that surged a chunky 5.3%.
That's a huge spread for two hubs that are, so close geographically. It suggests very specific manufacturing output pushing from the mainland, not just transshipments.
And it's not isolated either. We're also seeing gains from Taiwan, Seoul, and Bangkok on those key lanes into the U.S.
So it's not just the Pacific. The transatlantic data was, for me, even more shocking.
Oh, absolutely. London Heathrow, the BAI40, it rocketed up a spectacular 14.1% week on week.
14%. That is a massive move for such a mature lane, and Frankfurt wasn't far behind.
No, Frankfurt, the BAI20, was also up nearly 8.9%, a really strong showing out of Europe.
Okay, so what about North America? Chicago's BAI50 was up too, but it was a more modest 3.2%.
It was, and we have to keep that number in perspective. It's still sitting almost 18.9% lower than it was this time last year.
Right, so the volumes aren't quite there yet. But the rates are still reacting to something. And I think this brings us to the why of it all.
It does. It's what I-80's Willie Walsh was talking about recently. He noted that these geopolitical shifts are impacting air cargo far more than they are passenger travel right now.
We've been calling it the weaponization of supply chains. It's a strong term, but the trade flow data seems to back it up.
It does. Last year, cargo volumes between Asia and North America actually slipped by 0.8%.
But Europe to Asia?
Volumes there jumped 10.3%. That is a massive double-digit swing in the global movement of goods.
And that lines up with what we're seeing in the domestic sector in the U.S. The Wall Street Journal is reporting a retreat in U.S. manufacturing.
Employment is down by about 200,000 roles since just 2023. And tariffs are making everything more complicated, with firms scrambling for basic materials like steel and aluminum.
Which just adds more friction to the supply chain. Now, normally, if manufacturing is down, you'd expect rates to fall because of lower demand.
But they're not. And they're not because the physical capacity to move goods is choked.
Exactly. It's a capacity squeeze that's caused by all these snags in the system.
Right. Airbus, Boeing,
Yeah.
engine makers like GE and Pratt and Whitney, they're all juggling these competing demands. They need to build new planes, but they also have to perform maintenance on existing fleets.
And it creates this huge bottleneck on lift right as this mini peak hits.
And we haven't even touched on the energy bill yet.
The other shoe to drop. If you're moving goods, this is a huge deal. Traders are rushing to lock in oil prices. U.S. crude futures hit, around $65 a barrel in late January?
Yeah, that's up about 14% just since the start of the year.
And what's driving that volatility?
It's coming from two main places, really.
Yeah.
Geopolitical risks involving Iran and the weather. Those severe U.S. winter storms knocked out about 2 million barrels per day of output.
So let's put that all together for logistics. You have higher fuel costs.
And you have longer routes because of all the geopolitical tension.
Which means there's just sustained upward pressure on logistics pricing across the board.
Exactly. So even if demand softens a bit after the holiday, the actual baseline cost of operating the network has gone up significantly.
It really paints a picture where this mini peak momentum is kind of threatened by a very fragile ecosystem. We'll have to see how these weaponized supply chains hold up in the coming weeks.
Indeed. It's going to be a critical month to watch.
Until next time.